The CSO has announced its first estimates, provisional estimates, advance estimates of the full year GDP.
The third and fourth quarter growth rate could actually be deep below 7%.
The lead indicators have been pointing towards a deceleration in activity in the second half.
We may actually end up seeing a lower number than CSO's estimate also.
There would be an upside to this going ahead, I would believe.
Good morning. Welcome to Bazaar Morning Call. I'm Lata, and with me is Surabhi Upadhyay. Actually, we are missing two of our anchors, Anuj and Sonia. But I guess activity in the markets will make up for their absence. We're starting with green cues as far as Wall Street and Asia are concerned, but one maybe have to worry a little bit about the domestic cues. Yesterday, there was a very sharp resistance at 835 mark, 10,735 mark. And while we may have ended 25 points higher, we also ended 60 points lower from the day's high. So the market was telling you something. What were its worries? One worry probably was that there are too many poll promises, and you could see that in the 10-year bond yield, which had risen to 7.5%. Also egging it on to 7.5% is the way in which crude is performing. Of course, there are a bit of growth cues behind crude, but crude is also getting subject to potential cuts in supplies from Saudi Arabia and OPEC. So that's something which could be negative. But more importantly, perhaps the market was also presaging a slowdown in the third quarter earnings that will come. And that's exactly what the GDP advance estimates seem to be reiterating. They're telling us, the estimates are telling us that the third quarter and the fourth quarter are going to be slower than the first two quarters. So, I mean, I can appreciate the markets and the bulls' caution ahead of the earnings season. That was the message. That was the dominant message yesterday, if you please. Morning, Surabhi.
Good morning, Lata. Yes, I think there's a lot that the market has to contend with, as you mentioned. Even I've been going through some of these notes, and the realization now seems to be dawning that the benefit of lower crude oil prices might not fully start showing up in the third quarter, whereas some of the slowdown blues like the auto sector, etc., maybe those numbers will start showing up. Anyway, that's going to be a conversation as we go forward. For now, important to keep in mind, the one silver lining, Lata, in all of this is that positive FII buy number. Yesterday, we had a decent inflow number, perhaps the first big one for the month of January so far. We will also get the domestic institutional activity in terms of the mutual fund inflow, the retail inflow that's been coming in today. So hopefully the money flow will take care of some of these issues. But I completely take your point on the resistance. And this is something that even Anuj has been saying for a while, that the zone of 10,900, 950, the market's run into this level some 7-8 times, and it's not managed to take it out. So we'll have to see whether that can happen today or not. Just the one point also that we got yesterday, Lata, on the numbers, the CSO data, they're talking 7.2% with a bit of a pickup in manufacturing. I mean, how should this be read in the context of the bond yield already having moved to 7.5? Also, I think following the Reserve Bank of India's governor's comments yesterday on no added or additional liquidity support.
Well, the yield didn't move too much after what the governor said, because I think the yield is worried about what will be this farm package all about. Yesterday, you didn't get the farm package, you got an upper caste reservation. At least that is bond neutral. So we don't have to worry about that. But as and when that package comes, it will be a big worry. Bond markets are obviously discounting something for the next year. A big issuance probably, if there is a huge fiscal deficit. But let's come to the slowdown that the GDP advance estimates are indicating. The full year advance estimate is 7.2%. We already know the first half, that is 7.6. So the arithmetic difference is that you can only do 6.8 in quarter 3 and quarter 4. It's probably going to be 6.9 and 6.7 or something like that in terms of a breakup. But clearly, it at the moment looks like fourth quarter could be even slower than the third quarter. There is also, of course, the base effect that the fourth quarter will have to contend with. Within the estimates itself, manufacturing, as you say, has done very well. 8.3% manufacturing, construction at 8.9. All those numbers are fine. And so is the capex. Capex is up 12.2%. But if you looked at services, agriculture, that's where you get the bad news. Agriculture, both in current prices and constant prices, is 3.8. That means there has been no rise in prices. And that's where, rural demand is not kicking in, which explains why the consumption number is as low as 6.4%, not picking up as it should. And all the services is 60% of India's employer. And their, trade hotels is is down to 6.9 versus 8%. Finance is down to 6.8 like last time. And public administration is down by about 1 percentage point. So that's where the lack of demand perhaps is kicking in. Maybe we'll get an expert before we go on with this. We have Jahangir Aziz.
We do have, in fact, Jahangir Aziz, Head of Emerging Markets Economic Research at JP Morgan, joining in. So let's get his take on all these macro issues that we have to contend with. Jahangir, good morning. Thanks for joining in today. First up, this advance estimate, 7.2, as Lata is saying, that perhaps that points out to a much slower second half. Your initial thoughts?
Look, I mean, I think, I've stopped focusing on, levels of growth numbers, given, the uncertainty and the methodological problems associated with them. So let's just focus on the trajectory of it. So as, Lata was mentioning, we had a decent first half, and clearly there's a slowdown in the second half. At least the slowdown in the second half is consistent with what's happening elsewhere in the economy, what's happening to credit numbers, what's happening to the liquidity situation, including, what's happened to global trade, which has slowed down quite a bit. So at least we have the first half and the second half consistent, which is a relief. And I think that, the way we're looking at it is that this slowdown is probably going to continue till probably the second calendar quarter of 2019, so the first quarter of next year. And then once these, the impact of the liquidity and the financial conditions tightening fade, we should see some recovery in beginning in the second half of calendar 2019.
Second half of 2019, you mean this year? That's right now? Or you meant 2020?
What I meant, no, I'm talking about 2019 calendar year. So.
Okay. 2019 calendar, that would be well after. I take your point. But would there be election blues then? I mean, one hopes, of course, that we get a stable government. Could there be an overhang if there is some political dissonance?
Look, I mean, that is always, a risk that we have to confront with. But what I'm looking at is that, look, there was a reasonable degree of tightening that took place in financial conditions, whether it was done through policy or whether it was done de facto in second and third quarter of 2018. Again, I'm talking about calendar year 2018. It takes about 6 to 9 months before the impact of that completely filters through the economy. That's typically has been the lagged impact of financial tightening on real activity, and that should take us into second quarter of 2019. So it's not about whether there's additional risks coming from politics or additional risks coming from what happens in the February budget. All of those, I will contend, are material risks. But if I take these aside, just the mere fact that it takes about 6-9 months before financial tightening fades through the economy and filters through the economy, we should see a reasonable amount of pickup taking place in the second half of calendar 2019.
Jahangir, I want to know how smart money will behave towards India and EMs vis-a-vis developed markets. India has been the outperforming market since October. But now, as we get into 2019, the fears of tightening liquidity globally have somewhat eased if Jerome Powell is as good as his word, and both the rate hike and the contraction of the balance sheet is not as severe as the market estimated. And in India as well, the growth is slowing somewhat. Will this attraction of India over other markets continue?
I think what we should take, the lesson that we should take from the fact that the Fed has somewhat changed its guidance, and we do not expect rate hikes in the first half of 2019. We do expect them to resume in second half of 2019. So at least in the first half of 2019, we should get some relief. Is the reason why there is relief. And I think to a large extent there are two factors that is playing into this sort of holding pattern in Fed policy. One, of course, is concerns that is emanating from slowdown in China and in the rest of the China and Euro area as to the rest of the world. So this is not a great reason as to why the Fed is going to hold. And the argument is that there is this negative feedback loop that is coming from financial markets onto business sentiment, and that could impact investments and corporate profitability. So in a world in which monetary policy is being kept on hold because there are fears of global slowdown or fears of negative feedback from financial markets onto real activity, I don't really see in that world asset prices actually doing extremely well. So in a sense, the headwinds to growth or headwinds to asset markets have been probably reduced quite a bit, but there is no sign of any tailwind at this point in time to boost them.
That itself would be a relief to the bulls' ears for sure, Jahangir, if at least the headwinds have reduced. But just coming back to India, a lot of the chatter that I hear around in the market seems to suggest that, fiscal deficit, specifically for the way the equity market is looking at it right now, isn't too much of a concern. People think 3.3% plus minus few basis points here and there. But given all this talk of fiscal spending and the spillover into FY20, on the fisc, what are the kind of numbers that you have in mind right now, the realistic realization here?
So in a sense, we really think, there are two parts to fiscal deficit. One part, of course, is the central government fiscal deficit, but that used to be the big mover. But unfortunately, given the profligacy of state governments, contribution is probably about the same level at this point in time. So we do expect the government to make it to the 3.3, whether it's through finding new sources of revenue in the last few months or through contraction expenditure. Most likely you'll get 3.3 or slightly higher than 3.3 for the central government. The state government is a complete unknown because it is unlikely that given the even if I take away the farm loan waivers that have been announced by a handful of states, even without taking those into account, it was unlikely that the state governments would have stuck to their 2.3% fiscal budget deficit target that they had set overall. And more likely it will go closer to 3%. So we already have built in a significant amount of fiscal outspend or overspending coming from the state governments in 2018-19. And in 2019-20, we would probably get a number which is probably respectable from the central government. We'll have to wait and see how that number pans out for the rest of the year. But again, I've been talking about this for quite a while now. It's the state governments that really now moving the needle on how much of government, how much money the government takes away from overall savings to fund itself. And we do not really have a reasonable grasp on these numbers till 6 months after the year is over.
Yep. Oh yes, Jahangir, that's right. But thank you very much for joining us. Though at the moment the worry about the central government fiscal deficit is not at all behind us. The worry is that GST collections have not been up to mark at all. Direct tax collections have barely made it. They're just about 14% higher against budget estimates of 16%. So even there is a shortfall. Even if they make it up, you can't make up the indirect tax shortfall. And then there is this huge farm package for next year, which the market worries. We don't know how huge it is. We don't know whether it's a universal basic income. We don't know whether it's a bigger waiver. We don't know whether it's a bigger MSP. But that's what's keeping the bond yields extremely worried at this point in time. We were expecting it yesterday, but we only got some cast.
But then maybe you make a couple of PSUs buy out stakes in each other, or get higher dividends and those kind of accounting, creative accounting.
Yesterday, the big number that Dr. Gulati put out, we are not talking 20-30,000 crores, which is what you can get from divestment. We are talking 2 trillion to 4 trillion rupees.
Once this farm waiver numbers are actually
that can't be made by divestment. That is a genuine worry that it will take away every other kind of capex that the government is doing. So it's a worrisome number, but it's a worry in the head. Nothing has been announced.
Okay, we will see how that plays out. Of course, it's already started to show up in the bond market numbers. Anyhow, let's quickly run you through the call that our wise experts have for us as we get set for trade this morning. Neelkant Mishra of Credit Suisse says global market capitalization has fallen by 12% since the 1st of October 2018, but the Indian market cap is actually up 3.6%, helped by the rupee appreciating against the US dollar by 4.4%. But he adds then that in local currency terms as well, the market is broadly unchanged, even as developed markets have corrected sharply. He says the EM versus DM trade has been in place since the 1st of October in India, and India has been the 5th strongest market globally, behind Brazil, Indonesia, Turkey and the Philippines. He says, however, that such periods are usually followed by 1 to 2 months of underperformance. So we're going to be getting into that patch or not? That's an interesting thought point that Neelkant has.
Okay, so underperformance is one forecast here. Here's one positive forecast, actually. Harold Vandelin of HSBC says upside risks to Asian equities are much greater than downside risks. And this asymmetry in payoffs makes them constructive on Asian equities. They foresee an 18% upside for MSCI Asia and ex-Japan. They believe macro factors remain important and sector and country rotation is key, currently neutral on India.
Okay, let's move to the money markets now. And this is a view coming in from Bhaskar Panda of HDFC Bank. He says the rupee gained against the dollar in the early part of Monday before readjusting at higher levels. But today he's expecting the USD INR pair to start around 69.70 and then go on to trade in a range of 69.60 to 69.85.
Okay, and on bonds, Bhaskar Panda says the yields have risen in the past few trading sessions and he expects the trend to remain. He sees the 10-year benchmark bond yield remaining within the 7.45 to 7.55% range today.